All right, so today on the New How podcast, we have Jeff Gophstein. Jeff's the co-founder and CEO of Yieldeasy, an alternative investment platform that grants investors access to the real estate lending market. Born and raised in Philadelphia, Jeff previously worked in real estate private equity and was involved in over $1 billion of real estate acquisitions and development. Jeff also started a food truck, which we're going to definitely dive into. I got to know about that. And worked in the real estate brokerage and attended Drexel University. Jeff, welcome.
Thank you, sir.
Jeff, we've known each other how long now? If you had a water pistol to your head, how long have we known each other?
2015, 2016,
yeah.
something like that.
Coming up on a decade of knowing each other, and we've worked together in the past in certain ways, but you've been an entrepreneur like myself for a very long time, and I've personally seen you go through venture to venture to venture, each time getting a little bit more successful. And tell me about what you started in. Like, I got to hear about this food truck for one, but talk to me about how you got into just entrepreneurship in general.
Yeah. So first of all, thank you for having me. I was complimenting before we started the setup here. So I feel like I'm on a news broadcast show. Entrepreneurship, I think, runs like very deep. I think it's kind of like a nature versus nurture thing. It's almost something you're born with. I think you would tend to agree with that. Yep. I think the most common thing between entrepreneurs is they're virtually unemployable. Which just kind of leads back to what you just said. Like, you and I know each other because I used to work here for you and with you, and I hope I wasn't too bad. But no, I think that it's always something that I've just aspired to. I didn't know what it was growing up. It's like kids say firefighter, astronaut. It's like businessman, but what does that really mean, right? And I think there's a certain percent of that which is attributed to you are unable to do something for someone other than yourself, selfishly. And then I think there's also kind of like the creative aspect where you want to build something, you want to create something out of thin air. And obviously
I always relate, like for me, whenever I was working at a job, it was always like, well, they're doing it this way. I know it can be done better this way. And it was always like, I could see how to progress things and make it even more successful. And like not being given that opportunity is what makes entrepreneurs, I feel like, jump. Because I do know people have entrepreneurial tendencies, right? Like, I'm going to help and I can grow this business, but they might not can take on all the stress. But like, if you run a business and you have someone with at least entrepreneurial tendencies, you're not giving them that opportunity, they're going to jump. They're going to jump.
They call that like an intrapreneur, like somebody that works entrepreneurially inside of a business. But like that feedback that you just said, like you can work in a company, you see what can be done better. Like, that's the feedback that gets you fired. Like, I've just been at places where you think outside the box, like that's a liability. And to me, I never really understood that. So I think that kind of drove me in that direction.
So you went to Drexel. Before Drexel, during Drexel, after, like?
So typical kind of like little kids side gigs that you hear everyone be like lemonade stands, buying and selling, iPhones and selling them on eBay, and shoveling snow, like that whole, every story that's told on a business podcast. But I would say where it got, and I mean, it depends what the barometer is for the word serious, but like I went to Drexel, and during Drexel, my two best friends and I, we were living together. We were watching Shark Tank, and there was an episode where there was Luke's Lobster. And they had the food truck, and we were just sitting there. I'm like, am I allowed to curse?
Yeah.
And I was like, why don't we just start a fucking food truck? Like, that's literally a piece of metal. Like, we don't need to know much. We can learn it all. So we went on eBay. We bought a cart. We hired an artist to paint the cart. I sat in like restaurant managerial classes to learn like food safety. Like, mind you, I'm like getting my finance degree at Drexel. Like,
wait, what year in Drexel? Junior, like sophomore?
It was literally my last year. So it was 2016. And I was like, just screw it. I don't really care about school. I'm basically done. I got all my credits anyway.
I got my finance degree. I'm going to start a food truck.
Yeah, and so it was a peanut butter and jelly themed food truck. By the way, it still runs today. We actually sold it to a teacher he still runs it with his family, which is great to see. But no, that was like our first foray into business, but we didn't know anything about like a balance sheet, a cash flow statement, like what's our cost of goods, like are we profitable? We just knew, like, we went out there, we sold sandwiches, we made money, we got ourselves on Grubhub, and then when it was time to exit, like my one best friend got into medical school, and I started like realizing that I can't hawk PB&J sandwiches. So I was like, what do we do now? We didn't understand.
Was
selling.
it just PB&J, or did you layer other stuff?
We lit it up with a bunch of toppings and charged more for that. So
all right. Nice. All right. So food truck sells.
Yes.
Now what? Now you're an entrepreneur. What's next in your head? What are you working towards next?
Quickly fell flat on my face because I realized there was so much unknown that I didn't know. And I think that's kind of like where I said, okay, well, what's the next best thing? Like, where can I be entrepreneurially driven, get into a space or a sector where eventually you can break into it? And I was always in school for finance, and I had all my co-ops from Drexel, which is, for those who don't know, it's like an internship on steroids. You're working full time for a couple months. You had that at Jefferson, right?
No, but I know Drexel has an intensive one where like you're going back and forth
full time. Yeah. So all my experience was in like private equity and wealth management, and I thought I wanted to do the whole investment banking thing, and I thought I was going to work in New York. So I realized that there's really not a lot of like, you're not going to start the next BlackRock, and you're not going to, start the next.
If you start the next BlackRock's coming in and buying you and just giving you money to just step aside.
Exactly. So I kind of fell into real estate by accident. So I turned 18. I got my real estate license, like everybody does that's interested. I did some stuff for family and friends. I did some rental properties where I would get, first month's rent. Then I started brokering some deals. And then I got introduced to, I guess what's colloquially known as real estate private equity. So got introduced to a lot of people that who I worked for, and really kind of just jumped, I don't want to say jump shop to shop, but like went to a shop. And a lot of the companies that I worked for, especially like in my role in acquisitions, like a lot of real estate people know, it's all very cyclical. So like these acquisitions roles that I had where I was working in these big real estate companies was very market dependent. So like if it was a great market, we were doing great. We were buying deals. We were underwriting tons of deals. You're putting stuff under contract, like everything's, it's all gravy. The market slows down, interest rates tick up, all of a sudden your job is not really needed. And everyone's looking around like, well, why is there an acquisitions team if we're not in an acquisitions mode? And that was kind of always in the back of my mind. Like, I don't see this being like a long-term thing for me. Like, it's a very good foundation for people to get into, because I don't think without those roles, I would have ever learned how these deals are underwritten. Like I went from like selling, homes to like dealing with like large real estate transactions. So it was very useful, but I would say the entrepreneurial journey started way, way after that.
Yeah. So you're working for these different brokerages. You're doing $1 billion in real estate trading of acquisitions, tip positions, right? Getting rid of them. So now you're what? You're out and you have an idea for something. Like talk to me. Like how did Yieldeasy come to be?
Yeah. So right before COVID, it was kind of this like big tech boom, or at least like the wave started. All these tech stocks were blowing up. A lot of like you saw historic amounts of like venture capital funds being raised, and
money was just pouring into these. You put a tech logo. You're like, I got some people in front of a computer screen doing code. They're like, $5 million seed round. You need $5 million to go.
Yep. And so I kind of like my interest peaked in that, because I also have like very, I have ADHD. So I'm always looking for a shiny object. So I was like, real estate. I was actually working for a brokerage at this time, like pre-COVID, and I was flipping houses on my own. So I was like buying properties in Philly, going through the whole Burr method, like that very well. And I just saw the amount of retail investor demand. And when I say retail investor, I mean like non-sophisticated institutional real estate. So everyday real estate investors like you and I, people, they could be lawyers, doctors, dentists, like these are guys that just real estate started to like really explode. And it was on Twitter, and everybody was like a syndicator, and everybody was doing real estate. So I sold this like property that I was flipping, and it was to a non-sophisticated person. So they had trouble going through the inspection process, the appraisal, like getting a property management, a title, like there were so many third parties that were involved and people didn't even realize. And I was like, there has to be an easier way to like get exposure to real estate. And that kind of was the, thesis behind Yieldeasy.
So essentially, without diving too much into it, so the idea was like, there's all these different segmented pieces of a real estate transaction, from buying it to title work to managing the property all the way through. You were looking to create a platform that tied in most of those pieces.
Essentially, yes. So we basically, I didn't know, we launched, I didn't know what that meant. We just kind of like, I bought the domain. I started like, putting together a pitch deck. I was just me. I was a sole founder. And we got into an accelerator program, which for our viewers basically is like a incubator where they accept businesses, they give you funding, they help you kind of like get the ball rolling.
Connect dots and resources for you.
Exactly. So we were kind of humming along. It was a program in New York, a fairly well-known one. And we launched our first MVP, if you will. We got a bunch of channel partners signed on, and we had a big demo day. And the interest rate market went from 2 to 7. And so our business was essentially hit in the face with a shovel.
Worry. At least you didn't buy like 1,000 horses the day before Ford Motor came out.
Right.
Could have been way worse.
Yeah, exactly. Or I didn't buy any rock JPEGs during that whole gold rush. No, but so we basically got hit in the head with a shovel. Like it was like every prop tech investor and venture capital fund we talked to said, your target market does not exist any longer because the days of free money is over. Interest rates are high. And my brain kind of started, thinking like, do I throw in the towel? And then that just goes back to the whole entrepreneurial thing. Like, being a founder is all about like being punched in the face 1,000,000 times, getting up 1,000,000 times. So I was
zigging, zagging, moving from left to right.
Changing, pivoting. And so I said I can either pivot like with the direction the market's going or kind of fight the forces that are the market. So I decided to pivot. And so I caught up with a buddy of mine who's now my co-founder, who was previously in the mortgage business because everything was all about interest rates. Housing prices were through the roof because interest rates and like they were continuing to be through the roof, even though interest rates were so high. Was explaining to him kind of like what had happened. And we kind of basically in one phone call had this realization that the original thesis that there's a ton of people that want real estate exposure still exists. But how do you parlay that into what's going on in the interest rate world? And so we realized very quickly, like you can change the ownership offering that you're doing, and rather than be on the real estate side, you can be on the lending side. Because this is a lender's market. And so that's kind of what we decided to pivot into. So for lack of a better word, we created Yieldeasy. We're pivoted into a alternative investment platform that grants access to the real estate lending market.
And what's like so is it open to anyone? So it sounds like if I've actually never invested in real estate, I could go to your platform and put in money to lend on real estate deals, essentially?
Essentially, yes. So there's some regulatory hurdles because we are crowdfunding right now. We offer only to accredited investors, but for lack of a better word, yes, you can. We have a in-house originations partnership that lends all across the country. They do hard money loans, bridge loans, whatever you want to call them. They're all secured by real estate, all first lien, all conservatively leveraged, nothing past 70%. Some of these yields are up to 12% net to the investor. They're short term, so like less than a year, sometimes a little more. And then so we have a marketplace where people can actually go register, check out some of these offerings, and they'll see this property and waterfront lakefront property in North Carolina. Here is the loan. Here's who the borrower is. They can download the appraisal report, do their own due diligence, and essentially invest in a loan that is secured by this piece of real estate. And so we take care of all of the servicing. You're getting a fixed monthly fee. And this just kind of goes back to our whole vision that like in the insanity that is this real estate market, we're kind of bringing this like liquidity, fixed income, still have exposure to the real estate market. And meanwhile, just kind of creating a tech platform that hasn't really existed. Like hard money loans exist, alternative assets.
That was one of my questions. What's the difference if I just went to Yieldeasy versus calling up a hard money lender that I know in Philadelphia? Like why would I go to you versus them? To get money,
correct. Yeah. So the biggest difference with us is we are not a lender, right? We are not an originator. We don't write loans. We don't deal with borrowers. We are simply a tech-enabled, essentially platform that connects retail investors to these lending opportunities.
So essentially your platform. So if I was a hard money lender, I could get on Yieldeasy to make my life easier
and sell your loan to us.
Sell my loan.
Correct.
Got it.
Correct. So on the other side of the marketplace is we're actually bringing liquidity to the hard money lending market.
Amazing.
And you know the space very well because 99.9% of hard money lenders, and there's about 10,000 of these guys in the US, they're lending on what's called a warehouse line of credit, which in those documents, there's a stipulation where they cannot keep the loans on the books. They have to sell them. And so the institutions they're selling to basically put their pencils down because of the market, and these guys have nowhere to sell to.
And sometimes what's even crazier in that fine print is that those warehouse loans can come and be like, we're calling that loan back and skip over your hard money lender.
Exactly.
Which is a little scary. Some people don't know that, but it happened with this recent shift to some people I know.
Yeah. So it's the idea here is that we are what venture likes to call asset light. So we don't lend. We don't have the We don't have to have the infrastructure, if you will, where we have to have like a chief appraiser and like we have partnerships with lenders that we rely on, that we have our own kind of underwriting that we do before we take the loan in.
So are you then building tech with Yieldeasy for those lenders to make their lives easier? Like, even though you're not lending the money and like, hey, you can upload your docs here, right? Like, are you starting to kind of build out that chain of all those different pieces?
Absolutely. So we have essentially a pilot partnership with our first originator. And the idea is that we're going to basically help them, they'll help us as well, where, they originate loans, we take those loans, we put them up live, and then we're going to go out to the market and say, hey, like, we are now buying from all of these lenders. And we're going to basically have a back end. It says, this is our buy box. These are the types of loans we buy, these types of properties, this type of LTV, this type of, yield. They get put up for consideration. Yieldeasy would buy those loans, therefore, giving liquidity back to the original lender. We now have that loan as an asset, and then we can securitize it, put it on our marketplace where retail investors can come in and earn, up to 11, 12%, where we're servicing the loan. The biggest difference is it's not peer-to-peer, right? Yeah. So a lot of these platforms, I don't know if I'm allowed to like name other platforms. I guess I'm allowed to. But some of the largest alternative investment platforms in the world are crowdfunding and peer-to-peer. So meaning they're simply an escrow between the retail investor and, let's say, the real estate developer on the other side. Every offering that we do comes from us. It's a Yieldeasy held loan. And so a lot of people really like the fact that like there's no.
Well, you're taking the risk too. You're involved, and means you're even vetting the deals harder than they probably should be vetted in some instances.
And we are we essentially are the lien holder. Like, if shit hits the fan, the investors know that we are invested alongside them. And they are protected because these are all first lien notes, and they're protected by the equity that's in the property. And so,
well, talk about, you mentioned your team's infrastructure being a lean and mean. Talk about what your team structure like you're an entrepreneur now. You have a this is a little bit more advanced than a PB&J food truck, right?
Absolutely.
Talk about your infrastructure, your team, and maybe kind of where you're heading on that front and what you're building out.
Yeah, I think to your point, like one of the most important things, like for future founders or people thinking about this is like, and you can probably, I'm preaching to the choir telling you this, but keeping a efficient organization, right? And I think some of the mistakes that a lot of these other companies fall into is they raise a ton of money. They think they need to hire 500 people.
I'm going to get CFO, I'm going to CTO, fucking chief heart officer. Exactly, bring them all in. We're going to have ping pong table and let's roll.
And so you're seeing this right now with a lot of the companies that over-raised too much money in VC dollars in the pandemic. Like they raise, they hire, and now all of a sudden it's layoff after layoff every quarter.
Absolutely.
So anyway, back to, to answer your question. So it's me, my co-founder, and another co-founder. We have a 3-person kind of...
The tri-founder.
The third guy just came in. He was actually ex-cadre. So... Okay. Big real estate crowdfunding, private equity tech platform, and he joined very, very early on and helped kind of build out our entire investor relations pipeline, our sales process. Talking to clients, getting all the inbound leads, the marketing strategy, and so I think the one thing that's been super, I think, strategic is like finding talent and identifying talent that is like very core to your business and not letting that talent go, right? And so it's 3 of us. And then we have all kind of contracted out. So we have a full stack development team of 5 engineers, but they're all contractors. We have a head of content and brand contractor. We have a growth marketer contractor. And I'm kind of emphasizing the contractor thing because this is how you stay lean.
That's how you start too. You don't just bring it all in house day one, right? Yep. You want to work with someone that, they don't do well, you don't pay them. Right?
Exactly. And not only that, it's like now I think I think work from home has created this almost like contractor economy. Yeah. There's entire companies. Like I have one of my advisors and mentors. He has an e-commerce business. They do $100 million a year in revenue. You wouldn't even believe the percent of his human capital allocated to core employees and contractors. I think it's 90% of his company is contracted, out. So this is kind of like the way that I think especially remote teams,
the tech space is moving that way and it has been moving that way for a long time.
Yeah. So that's that is kind of, I think, how we plan to grow. I mean, certainly in the future, we're going to probably raise, a larger round of financing to get us to a point, but that comes with, supply and the demand in the business.
I'd love for you to chat a little bit about the VC involvement, because a lot of, founders think, hey, I'm going to just go raise VC capital. I'd love for you to talk a little bit about the good and the bad and the all around of what that means to have a VC as part of what you're doing.
Absolutely. Yeah. Very, very good question. So for context, I didn't know what VC even stood for 3 years ago. I just knew the only thing I knew about like investing business was like watching Shark Tank. Venture capital obviously has been around since probably like the 70s, and like there's very famous ones like the first guy that wrote a check into Apple and the guys that wrote a check into Facebook, right? And now there's entire industries, and you have Andreessen Horowitz and Sequoia and these massive, massive funds, and their job is identifying companies that need essentially rocket fuel to grow. And so our business is, most would argue, a tech-enabled finance business, right? Like we're not SaaS, we're not B2B enterprise, like we are not a tech company, we're a tech-enabled business. And so for us, finding the proper investors who understood our growth and like our goals was very difficult, because getting venture capital dollars, itself is a full-time job, and it's like a needle in the haystack, because you have to have hundreds and hundreds and hundreds of conversations just to close, what's called like a lead investor. These are the guys that come in and set the terms for your round. And if you think about like how many people, it's almost like a self-fulfilling prophecy, because money was so cheap. Everybody and their mother was starting a venture capital fund, which then the other side is like, oh my God, there's so much money on the sidelines waiting to be poured into companies. I'm going to go start a company. And so all of a sudden you have this like tsunami of tech startups, and so many of them are getting funded. I'm just kind of giving you background here. So many of them were getting funded during like 2020, 2021, crazy, hyperinflated valuations. And the problem with these hyperinflated valuations is like, that is an arbitrary number that you need to grow into or increase at your next round. And the market is going to dictate like, okay, it's been a year, you ran out of money, I need to get more. My last valuation was $50 million. Is the company worth 50 million today? Did we grow by X amount of users? Did we grow by X amount of sales? No. So why would it be worth 50 million again? Especially with interest rates higher. So the point being is like so much of these companies basically got written down to zero. I think it was like 40 billion. I don't know what the number is. I'll get the article, but like a crazy amount of money.
Billions and billions.
A lot got basically written down to zero. And so we started this business like in arguably the worst real estate market, the worst interest rate environment, and the worst venture capital environment, like probably known since like startups had existed. So we were very lucky to find a group that understood kind of our growth objectives. The biggest, the question you ask about, like, talk to me about the VC environment is like, most people think that if they have an idea, they need to go talk to a venture capital investor. And that's not true, because venture capital at its core, when fundamentally used correctly, is meant for businesses that require, basically, like I said, rocket fuel. They need millions and millions to get to a proof of concept. And whether that's being spent on engineering hours or that's like just being inverted on sales where you're just losing money to gain customers.
Share, right? Like, hey, we have to get to this 30% market share and then we're making money. But we need 30 million to get there.
Exactly. And so I think there's plenty of room for, like us, I would say we're a hybrid, right? Like I'm not going to sit here and tell you that we're a B2B SaaS company that requires a round of financing every year. We're going to have this, multi-trillion dollar, like that's just not true. The reality is there's plenty of businesses out there that can raise from a venture-like group and, sell for a very decent amount or have a very large exit or be acquired or whatever it might be. But I guess the biggest thing is like a lot of founders don't know the nuances. And so they come in, they make a pitch deck. They might have a very viable business, but maybe it's not one that requires venture capital. And there's 99% of businesses
diesel, not rocket fuel.
Exactly. And like 99% of businesses don't need venture capital dollars, right? And so for us, like we are a tech-enabled platform, so there's still crossover into the venture world, and we talk to a lot of like alternative, investment, funds that are in like as angels or venture capital investors, and it's like being very realistic about the fact that like, look, we could build a very sizable company, but we don't need to, have 10x valuation jumps every year that don't really mean anything.
No, that's great. What's been the hardest challenge so far to getting Yieldeasy off the ground? Obviously you did it in the worst time, but like what's been the hardest thing, and then what's been the best thing about it so far?
So I would say the hardest part of growing a startup is the unknown, right? Like there's an unknown every single day. And this is why there's actually some investors that will only invest in second-time founders. Like literally, you could have the best idea, best team. If you're a first-time founder, some funds won't even touch you because there's so much, and you know this as a business person, like oh, I'm doing great today. And then next thing you know, like you're getting punched in the face because all of a sudden you're like, you got to do this from a regulatory standpoint, like payroll, how do taxes work? Like, I don't know what a cash flow statement is, right? And so I think the massive amount of unknowns is what is the most difficult about a startup. However, I think to the other side of that, that's also the best thing about it.
Yeah.
Because as you can probably attest, doing this is like a free MBA. Like I've always said to myself, like, no matter what happens, you will never learn more than when you're actually in it and doing it. You're not going to learn this in a classroom. You're not going to learn growing a company at Harvard Business School. You're going to learn it growing a company. And so I think that the overwhelming stress is also the overwhelming kind of like benefit to doing it. It's not for everybody. I say this all the time, like it will thin your hair out, turn it gray.
I used to have a lot of hair.
I used to have a full head of hair. Like there's days where you're just falling asleep thinking about like your spreadsheet that you need to then get to in the morning. So, but it's extremely rewarding, and not even from like a monetary business, just growth as a person, especially like fulfilling that itch that we talked about earlier, is like, this is what you wanted to do. Like, now you're in it. I
just love solving problems, right?
Exactly.
So like if you're constantly in a business where it's like problem after problem, people think problems like, oh my God, I can't have it. No, there's good problems like, holy shit, we just signed $1 million worth of work this month. How the hell am I about to fulfill that?
Yep.
I don't have that many hours on my team right now. What is it like?
Yep.
And that's the fun. That's what's always been fun about when I get into different businesses. It's like, oh my God, we're gonna start a haunted house. Like, oh my God, how do we find a makeup team? We got to build a makeup team, right? Like, it's just, it's the little things that like, it just keeps you going and keeps it fun.
And then you just go back, like you, for example, like now you have this haunted house. Like you could literally find a piece of real estate anywhere else, and you could do that again. I mean, like it A to Z now. You've already done it. So it's like, if I told you a year ago, like, let's go start a haunted house, you'd be like, I don't know the first thing, So I think like being knee deep in like very scary shit, for lack of a better word, is one of the most like scary, but also rewarding things. And like seeing the team get excited, like, I've even learned this like myself from you, is like all these like productivity hacks, like, Asana and Slack and like all these things. You're like seeing like tasks get like crossed off. You're like, oh my God, it's such a good feeling. Like we have a team, everyone's collaborative, everyone's like excited. Like we're like building all together towards this one thing. We're solving a problem for our customers, for our shareholders, like our team's excited. So from that standpoint, there's no better feeling. And by no stretch of imagination are we like, some massive company. Like we just went live. I was telling you, like we just went live in October. But we've grown our customer, amounts. People are depositing money with us. They're investing in these loans, and we're just seeing and we're iterating and getting customer feedback and changing this process. So it's very much like a running engine.
How big can Yieldeasy get? Like with this intermediate, the tech platform that you develop? Like what's the vision? Look like?
It's a good question. This is how I think about it. So if you look at some of the biggest and most successful alternative investment platforms out there, even ones, for example, I was actually just talking about with a buddy of mine today called like VinoVest, right? So they allow you to invest in wine. You can build a wine collection online. Don't touch it. You just have shares. They have, I think they're in the hundreds of millions and of AUM. Masterworks, they buy Van Gogh and Banksy and all these famous artists, and they securitize them. They're at $1 billion in AUM. The alternative investment market is projected to be like 25 trillion in the next 10 years. And I think that's a matter of the fact that it's never been so accessible, right? Like it's either been you're in real estate or you're in stocks.
I want to buy a Mona Lisa or a Mozart.
Exactly.
like how do I just go get a Mozart? Oh, now I can buy a share of it.
And so there's another company called Acre Trader, which I love what they do because they are opening farmland as an asset class. And like you would never think of that. Like, why would I do it? You go on the website, they inform you like, actually outperform the S&P 500 because they're not making any more of it and crops need to grow. So anyway, to answer your question, our business today is, as you know, in any business, is probably not the business that we're going to be in, 5 years from now, 10 years from now. And so that means opening up different asset classes. That means having different offerings, having enterprise versions, right? The real estate lending market, private lending market, not mortgages, like strictly the space that Yieldeasy operates in, is a $40 billion annual origination. So $40 billion of these loans that are given to people that are fixing and flipping houses or rental properties, or they just need bridge financing, $40 billion. 10,000 lenders doing it, all need liquidity, all need somebody to buy their debt. And then, like I said, the retail investor side, like there hasn't been a large player. We do have obviously some competitors, some of them extremely well, but nobody has really done it on a massive scale and really just focused on this kind of connecting the retail investor to the asset class.
Yep, directly, like no middleman. It's crazy. Okay, is Yieldeasy set up to go to different industries? Have you ever thought about that?
I think we could.
Like, will I be able to buy artwork through Yieldeasy someday?
So there is a large. Let me answer this the right way. So, but I don't know when this interview is going to air, by the way, but we're actually in the midst of a rebrand for namesake.
Cool.
So we're going to have a new name. So the new name is going to be Finresi. So finance.
When this goes out in a month here, hopefully it'll be public.
Yes. So the reason I bring that up is because there's another company that has a very similar name to us, and it starts with Yield. They are one of the largest alternative asset managers and platforms that exist, and they've opened it up to you can buy, marine deconstruction notes, and it's a loan that's backed by somebody taking apart a yacht in the Mediterranean, or you can buy, mezzanine financing on an office tower in New York. So I think this niche that we've carved out, where it's like you are directly correlated and tied to an individual asset, to an individual property, like you can actually see the fact that these are first liens, like you're signing called a BDPN, borrower dependent payment note. This is like the flow you go through when you do an investment on our site. So I think that there's a world where we can own the private real estate kind of alternative lending market. I'm a firm believer in like being a big fish in a small pond than the other way around, because ultimately it gets very difficult to compete. And you only hear of the moonshots that worked, right? You don't hear of the thousands that tried to do the same thing. So I'm a gambler, but I'm also very fundamentally driven. So it's like, I would rather know everything about this space, own as much of it as I can, create as much of a positive user experience for our users, than say, oh, we're going to own this and this and this and this.
Now, you mentioned that Yieldeasy right now, it's only for accredited investors, right?
Yes.
Like, talk to me, like, what hurdles do you think this industry has to go through to get to average Joe or Jane that maybe has $30,000 in their bank account? They're not worth over $1 million to be an accredited investor. How do I take that 30 grand and get investing?
Yeah. So accredited investors and crowdfunding came out of, I think it was 2009 when they passed the Jobs Act, right? And the crowdfunding became a way to raise capital. Part of that, was a stipulation that the person needed to know what they were doing. And the way they kind of limited their liability was like the person needed to be an accredited investor. What does that mean? They need to make one of the following: $200,000 a year. They need to be worth $1 million minus their worth of their primary residence, or they need to have licensure like a Series 7 or Series 63. I know there's a lot of talk in Congress right now about essentially lowering the threshold. So like you could take an exam, you could be an accredited investor. Certain amount of years working in a certain industry will make you an accredited investor. It's a very highly debated topic. I think for us, it also protects us, because if a person is non-accredited and they're venturing into an alternative investment, there's a lot of paperwork affiliated, like you sign a subscription agreement, we have a PPM, like there's a lot of stuff that it actually also helps the companies to know that there's an understanding, right? And so if you want to invest in a hedge fund, you got to be an accredited investor. If you want to be an angel investor in companies, you have to be an accredited investor. So I'm not against it, but I do think there is merit to opening it up to everybody.
Like, why couldn't it be the other way, where the company actually gets accredited to work with?
Yeah.
Like, because like you can make all sorts of arguments. Oh, it's privilege, right? I can't get into this investment because this rich guy or gal is only able to. Like, because especially today in 2024 with DEI, like, what the fuck? Like, why aren't we including everybody in this?
Agreed. No,
right?
and there are by the way, there are a lot of companies in the alt space that are doing it. Arrived Homes, like Jeff Bezos, one of the investors, like it's a big company and it's fractional ownership of homes. And start an account with $150. The issue quickly becomes, is it a vanity metric? Like, is it just a nice thing to say, or is it fundamentally good for business? Because we thought, like, we actually have the ability to do it. There's something called Reg D and Reg A, like, and it's part of this kind of 506C crowdfunding. I'm not going to bore you, but we had and still do have the ability to open this up to non-accredited investors. For our case specifically, is it sticky to somebody to invest $500 and make 10% annually? Probably not. And it's going to cost us as a business the same amount to get that customer, right? Like, what is your CAC divided by your LTV? Like,
Correct.
well, you know, the customer acquisition cost is going to be X amount of dollars. The long-term value of that customer investing $500 is not much. Yeah. And so back to another point of like venture capital, venture is going to say, we don't care, because the more users you show, the better for your next valuation. But from a business standpoint, it's just wrong.
Yeah.
So there are a lot of platforms, and I think like some of that have really won in this space is like Robinhood, right? You want to start with, you know, and by the way, like as much as we are in the alternative space, like I still firmly believe like the average person should just buy an index fund and contribute to it all the time. Like that, like I still believe that. But there is a place in everyone's portfolio for alternative investments. And I think, you know, we fit in there at some point. So yeah, I think I'm getting off track.
It's just great because I mean, some people spend their whole lives trying to become an accredited investor, and it's like, you know, they're missing out on opportunities. Yep. And it's you know, I get it. You also want to protect people, but also, you know, limiting opportunities. Look, if it's something where the business or the founder is doing something morally wrong or even illegal, right? Like, well, that person should spend the rest of their life in jail, right? 100%. Like that's what should be the outcome, right? Yep. But like, I feel like just saying, oh, you're not a millionaire, sorry, you don't get access to this. I don't feel like that's right. No, I think there needs to be an intermediate party, whether it's government backed or something, that can come in and be like, look, Yieldeasy or, you know, Finresi, whatever you're getting to, you know, they are doing things right to the right standards. They can go take $100 from people and help them invest it. And look, maybe your platform's not the right one to do it just because of the cost for the business. But I know, you know, it sucks when, you know, take 30 grand. How do you make money on 30 grand if you don't have access to alternative investments? It's very hard.
I agree.
It's going to sit in the bank right now and make, you know, 3-4%.
Yep. If you're lucky.
But
when rates come back down, maybe it'll make less than 1%.
Yeah. In their savings account. I just feel like there's people missing out because they can't have access.
No, I do agree. And I think that there's the percent of people that are non-accredited is much larger than those are accredited. I think there's about 15 million accredited households in the United States, and there's way more obviously non-accredited. And I think it's definitely a hurdle, but there have been a lot of companies that have got it right where, you know, you can get access to real estate, you can get access to the stock market, you can get access. There's actually some venture capital apps where like anybody can invest in like $100 in like a venture fund. I actually think there's going to be a lot of M&A activity where so many of these alternative platforms that have come up are going to start either buying each other or getting swallowed up by larger companies. And then I think everything is dictated by the market, right? Yeah. And people will not, you know, shy away from making money. So if there is money to be made with the everyday consumer and retail investor, that they will find a way to do it. Yeah. You know, maybe you have to be a much larger company with a lot, you know, bigger pool, but you know, I think eventually every asset class will be democratized in some way for the everyday consumer. And I think honestly, like that's going to uproot the entire foundation of like,
that's what crypto did.
Yeah, exactly.
That's, like, I mean, that's literally why crypto,
it's going to uproot the entire like foundation of how people look at investing their money. Because like I said, for the longest time, it's been you either are in a Vanguard index fund or you are in a real estate. And if you're maybe a little bit more sophisticated, you have an uncle that's a real estate investor and you can put money in his deals. But like now you can invest in wine and artwork and vintage cars and, you know, all this stuff is like regulated online and done through the SEC. So
you're close enough to understand what's going on. Where are interest rates going? Just in your, I mean, no one has a crystal ball, but like the people you're talking to doing these loans, like I'm sure you're underwriting and hedging certain things on some of these deals. Like in your opinion, over the next 6 to 8 months here, are we seeing a difference or is it 24 months? Like I want your opinion. I'm sure the listeners want to hear your
yeah,
opinion
it's a good
on this
question.
as well.
There's a famous quote or a question somebody asked. It was like, I forget to who, but it was like, what is the market going to do? And the answer was, it's going to fluctuate. Yeah. So I think that what we're seeing is like unprecedented and there's nobody that can predict it based on like the amount of like non-traditional things that are occurring that surround interest rates. Like in a normal world, interest rates go up, housing prices comes down. And like, what have we seen? We saw, I think during the pandemic, a unprecedented amount of money that got printed. And a lot of people debate whether that was the right thing to do or the wrong thing to do, you know, whether we let the economy tank or we keep the economy kind of afloat with like an IV. And so, you know, real estate prices went through the roof. And so once the inflation kicked in as a byproduct, interest rates got raised to kind of curb that inflation. But what are we seeing? Now we see increased interest rates, but we still see inflation, right? And so housing prices have cooled a bit, but not by much. They're not anywhere near pre-pandemic levels. And the demand, crazy enough, has also not really cooled by the proportionate amount. I just saw
an article, someone from the Fed was being like, yeah, pricing's not going down.
Yeah.
Like people like, oh, they're going to wait for groceries to get cheaper. Groceries are not getting fucking cheaper. Nope. I'm sorry. Nope. They are fucking staying where they're at and then some. It's crazy, but that's the facts.
I was just listening. I think there's like, there's different types of inflation, right? Like there's like the demand pull inflation and supply. Like I think demand pull inflation is kind of where we are, because the United States is naturally a consumer economy, right? Like we are propped up on consumer lending, credit cards, and we have all this artificial money that's kind of been put in our pocket, whether it's through, your Capital One credit card or your home equity line of credit. And that just continues the flow, which,
it's all got pulled back too and more expensive.
Exactly. And like, I think now there's like historic amount of credit card defaults. There was a historic amount of auto loan defaults. So it's like, where does all this go? It's almost like kind of scary. It's like a vast ocean question, because it's like, well, the United States has to be too big to fail. But like, what happens if the consumer lending market crashes, the auto lending market crashes, the real estate, lending market, like the government's got to step in again. Like, is it going to be,
you seeing what's going on in China, where they're just shaving off $1 trillion in their market?
Evergrande is the largest, state-sponsored real estate development company there. The government told them they have to liquidate, and that will have repercussions in our real estate market. And I think, to get more specific, like, I was in multifamily, so I was not really in office, but the amount of office, like, because of the whole work from home thing, like my fiance works from home. I don't know if it's going anywhere, because now the employees kind of have the leverage. Like, you want talented people, it's not ping pong tables anymore.
But what's happening, and I'm seeing it, we're still getting calls to do office work. Companies are bringing people back because what happened was, what people don't realize, like, everyone went home, right? The big companies, like, dude, these people making decisions, these big companies don't own the fucking companies, right? So they're just like, oh, we got a pile of fucking cash. Like, let's just keep the business going. We'll do jobs. But they didn't realize that, I promise you, they're 20, 30% not as effective as they were previously. And I'm telling you, that is starting to catch up. I'm seeing it in the architecture industry.
From productivity standpoint.
Like just in the service-based industry, right? Like, oh, we were fine. We're 5 days work from home. Now we're going to be 4 days work from home. All of a sudden now they're 2 days back or 3 days back in the office to work from home. Right? Like, you're seeing it come. And I'm telling you, I actually just think the businesses that are, some of them are just going to cease to exist.
Right. Because too much of it is propped up on this.
It's too propped up on the bullshit. Like, I promise you, if you're designing a real estate asset or working in it, and you are not in the same physical room as that person, the end product is not as good as being on Zoom. Trust me, I'm the most forward technology-driven guy. Fuck, I'm looking at the Apple glasses. That it still sucks. Right? Like, it's not there yet. Someday it will be. But I promise you, being face-to-face at a table with trace paper in the middle, you are not designed. Unless you're doing that, the building is not as good. I promise you.
I agree from that standpoint. I think it's also very industry specific. Like, I think now you're gonna, like, back to my point on the whole. Contractor and consulting versus like bringing house. Like, I think, Upwork, like that created a whole world, because now, in your use case, 100%, right? Or if you're a real estate brokerage, like, you need to have a team meeting. You need people in the office. You need everybody motivated. You need everybody excited. But then on the flip side is like, okay, you're building a consumer app. You have a designer, you have a developer, you have a head of sales, like, do you need everybody in the office? I mean, it's great synergistically, but I think a lot of people would really disagree. I mean, I'm kind of somewhere in the middle, but I think as it ties back to like real estate assets, like it's going to take a while before those office buildings start to fill up to the full capacity.
Absolutely.
And there's like, I don't know what the stat is, but some massive percentage of like office loans are underwater, and like banks are going to start taking these like massive assets back. We see it
doing nothing with
it. I mean, we've seen stuff with like office to residential conversions, but like, you can't convert a 1,500 foot, high rise that's like in the middle of like so it's very difficult. I don't know what's going to happen. It's very interesting, going to be very interesting to see. But that to me is like what is a lot of the uncertainty around your initial question, which is like, what happens with interest rates? I don't know.
Yeah, it's gonna, I had someone on here, Jen Petrino. She was pretty much saying like, how much higher could they go, right? Like when they were at 2% to 7%, like, all right, wow, we moved 500 fucking basis points. Like, great. Can we move another 500? Probably not.
Right.
Can we move another 2, 3? Maybe.
Right.
So you got to hedge to a certain point, but also we could maybe move 2 in the other direction, like, with the whole presidential, campaign coming. But I don't know how they don't start at least letting it trickle a little bit to make some people happier and reduce their, credit card debt.
Well, that's what's going on with gas. You see what happened with gas when they let out all the reserves and everyone was like so happy because they thought gas price went down. Well, it didn't go down because of supply and demand. It went down because they flooded them with our reserves.
Yeah. I think things are just still settling, and you're still going to see a lot of yin to the yang here. Like you're going to see industries wiped. I think you're going to see, major businesses like, oh, we're bankrupt. Sorry, goodbye.
Well, this is what happened with the amount of all these startups that went out of business that had these massive valuations and massive kind of cash balances. I think in terms of interest rates, like I agree with where you just mentioned, like, I don't know if they can infinitely skyrocket because you're going to wipe out, industries. And I think the government's good at reacting to these things where like, they look at like home builder sentiment. They look at percentage of real estate assets that are being sold, month over month. And like these metrics all tie into the Fed's ultimate decision. But there's also so many things at play. Like me and you could sit down and read every economy book that exists. Like they'll never get into their heads with how they make these decisions.
What I feel is going to happen, right? Like if we didn't get the COVID stimulus and all that, and we just let it happen, right? Just let it all crash. Yeah, 50% of it would have been wiped, literally.
Right. Yeah.
Well, unfortunately, what I think is going to happen, I still think that 50% is going to wipe. Maybe it'll be 35%.
Yeah, they just kick the can down the road.
We're going to extend it.
Yep.
Right? Like, dude, if you were running your business a certain way, with the certain level of technology, and all right, good, you propped up and survived because you had no cash coming in because no one else had cash.
Yep.
Right? Great. But now cash is gone. There's no more cash coming in. How long are you able to continue operating your business? And are you still now feeling effects from COVID that affected your business to begin with? My gut tells me you're going to start seeing major companies be like, yep, sorry, we're laying off. I mean, I just saw today 6%, some tech company laying off 6% of their staff. It was DocuSign. And everyone fucking uses DocuSign.
And guess how many people were made up of the 6%? 440. How many people do you need to run DocuSign?
440 people.
That's it. 6%. You know how many people?
That's a lot of people. To run DocuSign.
How many people do you need to run DocuSign? And first of all, by the way, like I'm not saying I'm a tech genius, but like the products like look the same since 2010. So I don't know how many people you need.
But again, it comes down to how much cash you have in the bank.
Yep.
Right. Again, they're looking at it going, well, yeah, we could float this. We got $100 bajillion in the bank. We can keep paying these salaries. And then it's starting to get to the point where I don't think that's the case. I think you're going to see this yang come all the way back, and it's going to get scary here. And especially with the election, all the unknowns, like I think the next 12 months, it's not going to move. I believe interest rates stay right where they're at, not up or down. But what you're going to start seeing is the fallout. You're going to start seeing, these food, these food brands just go away because no one's able to afford them and buy them, right? Tate's cookies. Fucking love Tate's cookies, but I'm not fucking paying $12 for a fucking bag of cookies right now.
I just got a call. Way. Do you know how much a Big Mac meal is today?
I saw $18 fucking for a Big Mac meal.
Dude, I remember my mom used to give me $5.
That should be, if that's not an inclination of what's about to fucking happen, I don't know what is. The dollar menu is now going to be the $3 menu.
Exactly.
And it's going to be the same shit.
Like that meme introducing the new $1 bill and it's a 10.
Yeah, exactly.
No, I mean, and you even see it like tied, back to like Yieldeasy in the real estate market. Like there was so many of these syndicators that came out of the woods and start like selling courses, like fix and flip homes and blah, blah. And because people were borrowing so much money, that was free, right? Like you were getting 2% FHA loans and buying duplexes with them. And you had like very questionable appraisal values. And you saw this, there was actually companies in our industry that got in a lot of trouble because they had loans, specifically hard money loans, 95% leverage on crazy questionable appraisals. And when the tide comes, you see who's naked, right? Like you see who's bathing suits off. So it's like
there's a lot of bathing suits off right now, unfortunately.
So I think it's going to be very interesting to see.
Jeff, give me one zinger that the listeners, whether they're starting a business, in a business, something that's stuck with you that's helped you get to where you're at and where you're headed.
It's very tacky, and it's probably been said.
The tackier, the better.
Okay. That quote about like the the water when you're in a boat. Like look at all the water outside of the boat. As long as none of that water gets inside the boat, you're fine. I think that's how you have to think about like people's opinions, people's feedback, negative kind of connotations that people attribute to, what you're doing. I think part of being a founder is almost having like a psychotic level of like resilience. I mean, you and I have known each other for X amount of years, and like, how long I've been trying to do something, and now it's like finally the snowball's rolling.
You got crazy enough.
Yeah. So I think that's kind of that's the zinger.
Well, Jeff, man, I appreciate the time today. You left a lot of solid nuggets for the listeners. Excited to see where Yieldeasy heads, man. I'm hoping I can buy artwork someday through you, but we're going to keep with real estate.
Start with real estate loans.
Thanks for coming on, man.
Thank you for having me.
We'll see you again soon.
We will. Absolutely. Thank you.